Hello everyone, Sergey is here, and today we are going to do some dive into debits and credits. We'll do some further explanations about the concepts. I already did a couple of lectures about that, but I found some new explanations which I find very interesting and promising, especially for those who are new with accounting. So first of all, I would say it's good to define debits as destination and credits as a source, and we will look further why we can do that definition. And to get an understanding of debits and credits, we probably need to get some understanding of the basic work of the accountant. And accountant work by its substance is classification and combination and aggregation of transactions of a business. Why do accountants want to do that? Why do they need to perform so many operations over transactions? That's because there are many different parties interested in accountants' work. For example, management of the business wants the company to be transparent so that they can make decisions based on financial data available to them. Also, company might have investors who want financial statements which are comparable with different or similar businesses to the company. Therefore, there are financial reporting requirements imposed by some governmental entities, for example, Securities and Exchange Commission. Then there are tax authorities which want company to pay taxes, and they also need disaggregated and aggregated data on various transactions. And they also want, all of these parties also want to have a snapshot of entity assets and the sources for these assets, liabilities and equity. So in a simplified form, the most important statement for a company and the main reasons why debits and credits exist is balance sheet, or we also can say that it's accounting equation, which basically says that assets should equal equity plus liabilities. So assets should equal equity plus liabilities, where assets are destination for the funds, and assets is something that can generate us future economic benefits or provide any other form of benefits for the company. And equity and liabilities are sources for those assets. Alternatively, we can say that equity is whatever is left after we deduct liabilities from the assets. And if we use that definition of the equity, that's basically the same as we say as that assets are equal equity plus liabilities. And a balance sheet is just some disaggregated form of accounting equation where we classify various types of assets, short-term, current, non-current assets like cash, trade and other receivables, property, plant and equipment, and we do the same with liabilities and equity. So another financial statement of interest is income statement, where we are required to present separately sales like revenues, cost of sales, operating expenses, income taxes, and a few other line items. You can find more details in my videos about income statement. So we want all of that to happen, and we can get that information from trial balance, where we aggregate balances and transactions for the company. So let's return here. If we disaggregate further, we can define equity as owner investment plus retained earnings less dividends. And then retained earnings is revenues less expenses. You might have noted that that's basically our income statement. So whatever we have as a net income from our income statement, it gets into retained earnings and can be distributed in the future as a dividends. And assets. Assets as well as dividends and expenses. We can say that these are destination for our funds or for our benefits, for future economic benefits. So let's do some sample transaction here. I'll put in debit, I'll put in credit. So we invested $100,000 in the business. So a business gets $100,000 in cash. So that's basically, that will be cash account, debit, cash, and credit. And cash is a destination. So what was the source for that? And the source for that we got it from the owner of the business. So that will be equity. 100,000, and I'm making credits negative. In some sources you can see that credits and debits are both positive. I'm making credits negative just for everything to zero out. Okay, so we see 100k reflected on our trial balance, and we see 100k reflected in assets. So the destination for funds was cash and the source for funds was equity. Okay, so now let's do another example. On September 5th, Betty, our customer, promised to pay us $5,000 for a project once it is finished, and the same day we found a subcontractor to do a job for Betty. Yeah, I know that sounds unfair, that we made $2,000 of someone else's work, but business is business. I have a links here to reflection of these transactions in the QuickBooks. Okay, because of the accrual basis of accounting, which is a big topic for another video, we can only recognize revenues and expenses, like for revenues when earned and for expenses when incurred, and all of that happens when the work was completed. So let's debit, credit. So we earned 5,000 from Betty. So what will be a debit here? Because we haven't collected cash yet, that will be accounts receivable. So that will be Betty's debt to us, and that will be 5,000. And that is a destination for funds. And credit, the source of funds, will be revenue. Revenue from services. Okay, let's see what happened on the balance sheet. On the balance sheet we got 5,000. Our assets increased by 5,000, and that was a debit, I remind you. And on the income statement we got some revenues here, and these revenues flow to our net income, which in turn flows to our retained earnings. So the source for that asset, So that is a destination for funds, and the source for funds is retained earnings, which is equity. So let's see what happens then. So we can say that this is source. Then we recognize the cost of the services, the cost of the job done, $3,000. So what was the destination? This money flow to our subcontractor. So that will be our cost of sales. Cost of subcontractor. And that will be 3,000. Debit. Credit. So what was the source of the funds? So destination was subcontractor, and the credit was, because we haven't paid him cash yet, the credit was a liability, a debt to that subcontractor. And in case of subcontractors, it's usually accounts payable trade. So we got it here. If we take a look at the balance sheet, we still kept our $5,000 assets from Betty here, but we also recognized a $3,000 trade and other payables, a liability to subcontractor. And our retained earnings decreased because we recognized some cost of sales here. Okay, let's do a few more examples. Cash collected from Betty. So cash collected, the destination will be cash. So funds went to cash account. Let's see where we have it. Cash. And credit. The source for that funds was Betty's debt to us, $5,000. Okay. So we can say that that's basically this way. Let's see what happens on the balance sheet. On the balance sheet, we got 5,000 cash and no trade and other receivables. So destination was cash here and source was trade and other receivables here. Now we pay to subcontractor. Debit, credit. So where did the funds go? They go to accounts payable trade to settle the subcontractor's debt. And what was the source for the funds? And the source for the funds was our cash balance. We paid cash. Let's see. We have no trade accounts payable now, and our cash decreased by 3,000. And the final transaction. Owner used 1,000 of income for personal purposes. Debits, credits. So here, let's say it was cash. So he just withdrew cash. Now we know that since he used cash, credit should be cash 1,000. And what should the debit be? And the debit should be dividends or owner distribution account. Let's see if we have ones here. Okay, owner's draw. And let's see on the balance sheet. So our retained earnings decreased by 1,000 and our cash decreased by 1,000. So the source was cash and the destination was retained earnings. Okay, so let's see what we have here. We started with a balance sheet equation, which is accounting equation. It's all the same. It's here. As some common sense hint for accounting equation is your home equity which is basically your assets less your liabilities. So equity is equal assets and liabilities, and with a basic algebra you can say that assets are equal equity plus liabilities. Then we define the equity as owner investment plus retained earnings less dividends, while retained earnings is actually revenue less expenses. See also income statement. So that's we get that from the income statement actually. Okay, so now we can get a full definition that assets are equal owner's investment. So we just substitute equity here by all that data. So assets should equal owner's investment plus revenues less expenses less dividends plus liabilities. And then we move expenses and dividends to the other side, to the side of assets. And we have assets plus dividends plus expenses are equal owner's equity plus revenue plus liabilities. So these are usually destination for the funds, for the economic benefits. This is where we spend funds. This is where our funds go. And these are sources for our funds. So we basically get our funds from revenue. We can borrow our funds or economic benefits, or we can invest in our company, and that will be the source for our funds. While we spend money, spend funds, spend economic benefits on expenses, on dividends, and on assets. And to conclude that, there is a useful mnemonic dealer, D-E-A-L-E-R, and it's basically transformation of that equation into mnemonic D-A-A equal L-E-R. So when you try to figure out what is debit, what is credit, you can start with that mnemonic, and remember that assets, dividends and expenses increase by debits and decrease by credits. And as the opposite to that, owner's investment, revenue and liabilities increase by credits and decrease by credits. Thank you. Hopefully you get some value from that video. You can access the document in the links under the video, and have a blessed day. Bye bye.